Hey everybody, good afternoon. It's Doc Severson with 12-Minute Trading. I've been joined here with Dave Lukas. Today is Monday, the 2nd of October. So now we're into the magical fourth quarter, the Uptober of the market. We'll see if that occurs. We're in a really pivotal point right now in the market. We could go either way from this, and we'll spend quite a bit of time today talking about the possibilities. We'll talk about the price levels that you have to watch out for, and really kind of how to manage this style of market going forward. Is this a bull? Is this a bear? Are we at a transition point? We're going to answer all those questions. Dave, what do you see happening in the market right now?
I have been talking for the last month that if this bull market was going to get derailed, because we've been holding the line. Actually, as of today, we're still holding the uptrend for the bull market. And I've been saying that if it was going to get derailed, it was going to come from something outside that really wasn't being looked at, that wasn't necessarily priced in. It wasn't going to be a Fed thing. It wasn't going to be that. I thought it would be in the credit markets, and I thought it might come internationally. Today's moves with Japan are another kind of sign that things are getting a little bit wonky in the credit markets, for lack of a technical term. So it looks and feels more and more like the central banks are losing control. We had the 10-year Treasury hit 4.8 for a brief stint. Sitting around close to 4.7 now. And so the biggest thing I think we really do have to watch in the first half of October is the credit side. I would have expected, and it would have happened, I think, and I think everybody who looked at futures yesterday would have expected a nice bounce today on the news that we were averting a government shutdown in the U.S. And I think it was all set up for that until the Japanese came out and the BOJ came out this morning and had to intervene again, right? So I think that's going to be the story that plays havoc on this market for the next few weeks. I still think this week could be an up week. I think outside of that, you're going to have jolts tomorrow. I think that's going to be kind of setting the tone till Friday. Jolts is, the job openings report. And right now, according to Powell and everything, it all comes down to how bad can we crush the job market? That's what we want to see. And so if JOLTS, is looking like it's coming down, like there aren't as many openings or employers are pulling job openings, market's going to see that as positive. And then that's going to kind of hold, I think, if there isn't any more crazy stuff out of like Japan or in our own credit markets till Friday when we get the jobs report. And then that's going to be, really finalizing the week. And if the jobs report is under, I think the markets are going to like that, right? So that's kind of where we're at.
This reminds me an awful lot of 07, 08, where the carry trade with Japan was one of the first things that really started buckling the knees of the market, because people would basically use these different currency pairs as a way to like earn a return. Instead of sticking things in a bank, they'd earn a return just on the yen versus the dollar, and then pull it back and do whatever trades they needed. Well, all of a sudden that flipped and it blew up everything, and it started this whole snowball tumbling down the hill.
Exactly. And we're not there yet, but I mean, there's things that are happening in the credit markets are things that just have been happened in decades or ever in some cases. And so traditionally seasonality, what we would have expected is the last 2 weeks of September to be rough like they were, right? And then you bounce in the first week or so, 7 to 10 days of October. And then you have kind of a nasty dip about mid-October, usually puts in the bottom, and then you rally from there. And by the end of October, you're higher and you're off to the races, right? So that's, I think, still in play. It's only Monday, right? It's the first trading day of October. So we'll see if that plays out, or if we just, market uses this excuse to go down, put in that bottom sooner, and then start rallying from there. So I think the charts are kind of lining up to go either way. We were talking about that. So let's get in and let's talk about those levels. I think that's important.
All right. So I'm going to bring this out to just the monthly, the weekly, and the daily on the S&P. You can see the swing lengths on the weekly chart. We had the initial swing down from the July highs was about 272. We bounced up. Ironically, one of the bounces that we had into the August timeframe was jolts. The last time that we had a jolts, or was the one before that? I can't remember. It seems like all to run together these days. I think that was in the latter part of August where we had that. But yeah, that was a jolts report, was way out of spec, and started showing weakness, and the market rallied on that. But looking at the daily chart, we talked about this at length. I'm going to get my magic pen going here. See if I can get that to behave here. All right, so yeah, here we go. Here's the pen. Got to have the pen. Okay, so we talked about this a few weeks ago. We said, hey, from this consolidation, we're into the apex. It could break higher. And I believe we said at the time, probably would be best if we broke lower. And it certainly did. And that was a very hawkish Fed. And we all know the reasons for that. So right now, what we're in is a small flag. And it's no surprise because we hit this uber exhaustion down here on the daily chart. So range contraction. And we were setting the warning bells back here. We said, look out. Look out. When you have a market that's coiled up like this, you're going to get a big break one way or the other. Could it go to the upside? Yes. Probably going to come to the downside. Those are what are going to cause the biggest breaks. So we hit exhaustion. And so this is playing out according to Hoyle. This is exactly what it should be doing. Mm-hmm. Now, if you go back and look at this, and look at moves like this that come on a big break to the downside, we can look at a lot of these. Here was one from last December. Very similar. Okay, break to the downside, bear flag. That's as bear flaggy as you get. But what happened was everybody was expecting it to break to the downside. In fact, this is right around the time everybody was pulling out the 2008 analog and saying, oh, it's the same thing. And then boom, we went up. We went up from there. And it was really strange at the time because we did not see implied volatility spiking on this move. So that was a tell for us. So during a bull market, we're going to see these flags break to the upside. Now, an example of the opposite way of this is back in 2022, is every single one of these flags, when we flagged out like this, it broke to the downside. So we're going to find out an awful lot about today's market based on where this flag goes. And it's just getting started, right? It's just getting started, flagging out in this area. It's still holding the trend line, which you can see all the way back to here. So that's still good. Although I do have some targets down at 4,200. 4,150, and the bottom of this target is 4,100. So that's worst case scenario is we hit 4,100 before we bounce.
The moat.
I would say that's the moat, and actually
the mother of all trend lines.
Yeah, well, partly this is actually a lot more due to, let's see if I can get the right one here, Fibonacci extensions. So what we're going to do is we're going to, if I can get this thing to behave. Yeah, there we go. Okay, so we're going to run this extension down to here. Now, this is a classic ABC correction. So what we're going to look for is the C wave, or this current wave, which we've been in since the beginning of September. We're going to look for that to be either 100%, so it could stop there, but it could also go as far as a 1.618. which is going to be right down to 4,100. So this to me is the very bottom line. This is as far down as this one goes before we will see some type of relief rally, even if it's to a lower high. So this weekend we're pulling out all the stops in terms of technicals and trying to figure out where this market's going and where we could see some spots. So what Dave was talking about earlier was, Dave was saying, hey, if we bounce up from here, probably that's going to bounce to a lower high. And I absolutely agree with that. So any bounce up to this point, maybe 4,400, maybe 4,500, somewhere in that area, more than likely going to bounce to a lower high, probably going to roll over to another scary higher low. And then, who knows what's going to happen from there, whether or not it continues lower into our targets that we talked about, or this would be an excellent time to stick its foot in the ground and take off into the back half of October.
Yeah, this is the point. We're at that point where like everybody's negative. Like everybody's like, this thing's falling apart, and so on. Although you got a few Elliott wave guys that are out there going, this is wave 4 about to start the biggest rally in history and so on. But the most of the sentiment is negative out there. And it really is a moment of truth in this flag. And it's really hard right now to say, that this flag is going to break either way. We're probably going to chop almost most of the week like this at this point until we get to jobs on Friday. And that may be the catalyst for whatever the next move is. And that's I think what we have to be ready for. Like I told my students, I'm not trading until Friday afternoon at this point. I'm not doing any new trades till Friday afternoon. Let this thing play out and show its hand and everything. Because if it does go down from here, I think it's a quick trip. I think you're down to 4,100 pretty fast. And then, we'll see if that finds the bottom at that point.
There's an old expression on the trading floor that, from the CBOE and the CME guys. And they always used to say, when in doubt, palms out, because palms out
right.
was sell. Like in this case, this would be, selling like that, and buying would be like that. When in doubt, palms out. So if there is any doubt going into this Friday's jobs report, they're going to sell first and ask questions later. So we could actually get the move well before Friday.
Well, we'll see how we finish today. I mean, we seem to be going down to as of now, kind of to the lows of the day. NASDAQ's given back almost all of its gains for the day at this point. So just looking at my screen here. So I think, the final hour, I think how we finish today is going to be very, very important. But we seem to be, people seem to be just take risk off the table and not even bother with it. So
we're coming down to the expected move of the day. This blue line is the lower expected move. So pretty quiet. I mean, it's been really drifty.
Good piece of news, though. One good piece of news, and bam.
Yeah, just like kindling. Yeah, you're right. Is there?
Yeah. Good.
Oh, okay. Yeah, we screwed up the. Sorry, guys, I screwed up the volume again. So let's give Dave some volume. Sorry about that, Alan. Thank you very much.
Give me some volume.
There you go. While we're here, for anybody that's live, if you guys have any questions or if there's anything you'd like us to look at while you guys are here live, please let us know. Otherwise, if you're watching this on a replay, which is probably going to be most of you, let us know through email. And we're not going to be back next week. We're going to be doing a little traveling to Colorado Springs. So it's going to be a couple weeks. If you want to let us know, we'll make sure to put it into our next session.
Yeah, we're actually doing our fall meeting for the mastermind, for the 12-minute trading mastermind out there. Really excited about this. We've got jam-packed event, guest speakers, all that stuff and everything too. But great place. We're going to be at the Broadmoor right below Pikes Peak. So a lot of fun, but going to be really digging in on where things are going for the future of this, the rest of the year into next year and everything too. There's a lot happening out there, and preparing for all of the contingency and strategies that you may need in place is going to be a key thing that we're focused on. So, so excited to get with the group. But any questions, guys? Go ahead and ask them. I think I'm not going to wait and see if anybody has anything. The other side of this, though, is remember, we saw it in December. Some of the best bull runs are born from extreme negativity. And so the more negative it gets, the more people just hate the market and everything. And we continue to consolidate here and charge up. We're not there yet. That daily energy is not charged up yet. And so, it's going to take, like I said, the better part of the week to get that charged up. And so, the more negative people are, the better a chance that you're going to get a pop to the upside. Now, again, it may be short-lived, but coming out of this, I think, these runs are typically when people least expect them is when they come. And that's what you got to be thinking about. The market's going to do the market's going to do everything it can to take the most amount of money from the most amount of traders possible. So whichever way that means to go, right, that's what's going to happen.
You know, the biggest thing that I see from most retail traders is they make logical assumptions based on commonly available information. So all of us do that, you know, because, you know, generally if you're in some type of analytical role in a career, you're well compensated by being level-headed and saying 1 + 1 = 2. And you can do that for an entire career, although with AI these days, I don't know how much longer. But I mean, that's literally, if you look at a general analytical career, whether it's accounting or engineering or, you know, some type of science role or anything like that, it's being able to take commonly available information and deduct a conclusion out of it. And unfortunately, the market doesn't work that way. It does not work in a very linear and logical format. And we're seeing that to some degree even this weekend, you know, where we say, hey, we just avoided a government shutdown. We're good to go. You know, we should be rallying. And a lot of people took that and they saw the futures were up this morning and they go, let's go. And, you know, they're underwater right now. And, you know, that's like, they can't understand it. And, you know, the market's always like thinking 3 or 4 steps way ahead of everybody else. And it does take a while to learn that, you know, looking past the current move, looking past the logical outcome for things. So, you know, when we see things like really terrible news and everything sucks and everything's horrible, this is where we typically get like, hey, you know, we're about to see some pretty good stuff here. And that's kind of what we saw last year at this time, you know, where we were kind of banging out a low into the end of October, and then it failed to make a new low in December. And I was like, wait a minute. Hey, that's a change. And then, I mean, you can go back to last December when we were doing these things and we were bringing up that exact point. And so it's looking through the commonly available thoughts that will eventually push you over the hurdle to get that stone over the hill. If you're an investor out there that's trying to make things work, you know, and this is why we say you got to run with a wolf pack. You got to run with a crowd that knows what's going on and not just another Wall Street bets Discord. Yeah. Because that'll get you just more of the same.
Well, and it pays to think to the opposite. It pays to think contrarian too. I mean, always look at the contrarian side of where things are at in the moment, right? So like this is a moment in time right now in the context of still, I mean, if you pull up a weekly chart, still a overall bull trend, right? And so this is, I mean, we going up 30%, we got a 5% pullback. I mean, that's pretty normal stuff, right? And like you get 5% at this point, it's the end of the world because the bear market's fresh in everybody's mind. But that's a really normal thing. Pull back 5%, consolidate at, you know, a key level or so, and then head up higher from there while everybody thinks it's going to go lower. Everybody's going net short and everything like that. And then they get faded and they have to cover, and then that fuels the upside back the other way. And that's just markets. I mean, if you watch this stuff long enough and you've been around long enough, you kind of just start to get an idea and almost, I would say in some ways, you almost get a sixth sense for just how these things play out, because you've seen it over and over again. It's just the emotions of fear and greed playing out over and over again on, you know, effectively different timetables, you know? So just kind of think that through, think however you're feeling, right? If like you're feeling scared or fear, right? Like it's come too far, or like maybe your P&L's a wreck, you know, or something like that right now. It's typically about that time when things are going to turn around and go the other way. And so that's about the time where most people panic and they give in and they, you know, capitulate. And that if they, you know, stayed in just a little bit longer, the trades that they were in would normally actually be successful, right? And that's just it's just a natural thing that happens in the course of markets. And you just start to get to a point where you understand it and, you know, you let it play out and you usually can be okay. So, for what it's worth. And then opposite way, if you're on the other side and you are feeling like, man, I'm killing it and I'm crushing it, P&L's unbelievable. Guess what's right around the corner? I think I said that on one of these meetings a few weeks back at like the end of August. I said my P&L's doing really well right now. It's just cranking to the upside, and the trades are rocking, and that means that there's probably a move down right around the corner. And what do we get? We got the move down, right? So that's pay attention to that stuff. That's the emotions of fear and greed playing out.
Yeah, well spoken. So we got a question that just came in from Marathon Petroleum. So MPC. So I'm going to go through the standard fractal analysis for this. So what I've got here on MPC is the monthly, weekly, and the daily chart. So we typically do a top down on this. So first of all, we're going to look at trend. Trend has been, very good for this thing. So even energy got hit by the sell-off earlier this year, but has recovered up to new highs. Okay, so this is going back several years. So trend on the monthly chart, an uptrend. Trend on the weekly chart is still an uptrend. Now, trend on the daily chart, you could make an argument that this has started to work itself into a downtrend. We do have lower highs and lower lows there. So we have rule number one, which is that larger time frames dominate the trend, which is what we're seeing on the monthly and weekly chart. However, rule number two says reversals start from the inside out. So reversal starting here at the daily chart. Now, what this reversal is doing is this is pulling down the weekly chart. So I would say everything is still very normal here. And also from an energy perspective, we got lots of energy. There's no shortage of this. In fact, we were in a weekly exhaustion signal just a few weeks back, which has been able to restore itself. So this is doing exactly what it should do. Now, what I would say is the warning here is this is the first warning. So the swing test is failing today. Okay, it's not a big deal, but that's the initial warning. What you have to watch out for on this chart would be a bounce from here and then another lower high, lower low combination, which would undercut. So that would deepen the downtrend. This would deepen the pullback. And what you have to watch out for is making sure that it doesn't print a lower low down there, because that would actually be a lower low on the weekly chart. And that would imply that any bounce up, if you break 140, any bounce up, let me go to a different color here. If you break 140, any bounce up would more than likely go to a lower high and then start that process. So that downtrend on the daily chart is propagating over to the weekly chart. If that were to happen, it's not happening yet. So I'm just sort of playing this one a couple of chess pieces ahead. So this is just now, as of today, showing a change in polarity to the downside, which I think is no big deal. Is if you're holding this one longer term, you hold on to this, you wait for 140 to break. As long as 140 doesn't break, you don't do anything. Now, if 140 breaks, then you consider on any bounce, you may want to get ready for a little bit of portfolio protection, either by buying puts in that area, or if you're done with the trade, you can just back out of it. But those are that's what I'm seeing right now. It's like we're just now seeing the very first beginning of the price kind of coming down here. So let me know if you have any questions on that, or Dave, if you got something to add to that.
Well, from a macro standpoint, I mean, you could stay on it. I mean, it's obviously had a pretty massive run, and interesting enough, right? What we talking about in June, oil was ready to go on a run, and oil related stocks. And so I really, really like oil in this environment. It's administration just passed new laws like on gas and everything else that is making it even harder on existing wells and stuff and everything to get oil and gas and all that stuff here in the United States. And then you got the Saudis cutting back along with Russia and everybody else. And so I think oil is primed to just stay at higher levels. Individual stocks obviously will fluctuate. We got earnings, guys, starting in the next couple of weeks, but I think the downside for the oil sector right now is muted. So I think you'll have some pullback, some profit taking. Like Doc said, maybe like that 140 level on MPC is a good level and stuff. But I think we're at a point where we're going to be in a decent range with a chance to go higher based on the price of oil. I think we're going to see oil over $100 a barrel by the end of this year. And so that's going to take any of these oil stocks with it. So a lot of the gains have happened. There's maybe a little bit more upside, but I don't see a massive collapsing downside from an oil standpoint, just the way the environment is right now. Now, the only thing that could change that is if we went into a true recession, but we are ISM was higher this morning. I mean, like the economy, at least the data around the economy is looking like it's still positive and good, right? So we got to go through where we actually see GDP contract for, should be 2 quarters. We'll see if they say that 2 quarters of contraction is not a recession this time, if that happens again. But at this point, that puts us well into second quarter of next year. So I think for the next 6 months, oil is a pretty good, not a bad spot to park in, or sell some puts into. I love Devon. I love Devon Energy, DVN. Anytime that stock drops into that 45 range or so, I think it's there today actually, or it's close in that range. Like to sell puts on that stock or buy shares and sell covered calls. Some of the other little ones that I like are CRK, WTI. Some of those ones, BRY has been a pretty solid one this year. It's getting a little bit beat up today, so not a bad time to maybe get into and get a little bit on that. But Devon pays a 7-8% dividend just for having that stock. So you pick it up at this low end of the range and turn around, you can sell calls 6 months out, pick yourself up another 10%. You're making effectively 17% on your money just for holding that thing for 6 months. So not a bad place to be.
I have got short puts at 42 on Devon, so I'm gonna be paid for that pullback if that occurs. So
that's a great place to get it too.
Still somewhat weak. So we'll see what happens in the final hour here. So we're just about out of time. So I want to thank everybody out there for joining us here today on Monday, the 2nd of October. So again, we're going to skip next week. We will be back here, whatever that date is. For the 16th, I guess that would be right. If that's right. So we'll see you back here in a couple of weeks, and boy, bet we'll have some resolution by then.
We may be in a completely different market by then. It'll be very interesting.
Yes, absolutely. Well, thanks again, everybody, for joining us here. So from Dave and from Doc here at 12-Minute Trading, we are out of here. So thanks, everybody, and
bye, guys.
We will see you in a couple of weeks. All right. And there we go.